Let me introduce you to Alex and Noah. Alex buys a house. Noah rents a place half the size and invests the difference. They both think they made the smarter financial decision. They're both missing something because one of them forgot to count the hidden costs, and the other forgot to count the psychological cost of watching prices run away without them. And when you actually run the numbers over 20 years, the answer will blow your mind. Let's keep this fair. Alex and Noah both have $60,000 saved. They both earn $70,000 a year. Same age, same city, same credit score, same starting point. The only difference is what they do with that $60,000. Alex uses it as a 20% down payment on a $300,000 home. Nothing crazy. A modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly principal and interest payment is about $1,600, but that's not his real housing cost. Property taxes add another $350 a month. Homeowner's insurance adds $120. Maintenance, if he's being honest, should be at least $250 a month. So before utilities, furniture, upgrades, repairs, or surprise problems, Alex is spending about $2,320 a month to own this house. Noah rents a smaller place for $1,700 a month. Same city. Not as impressive, no backyard, no garage, no feeling of ownership. He takes the $60,000 and puts it into a total stock market index fund. Then he invests the monthly difference between Alex's real housing cost and his rent, around $600 a month. On day one, Alex has keys, a house, and a reason to feel like an adult. Noah has a lease, a brokerage account, and a landlord who could raise the rent next year. Emotionally, it's not even close. Alex walks into his house and thinks, "This is mine." Noah walks into his apartment and thinks, "This is fine for now." And that sentence, "for now," is exactly why so many people believe buying a home is automatically the smarter move. But feelings and math are two very different things. For the first few years, Alex feels like he's winning. Every month, part of his mortgage payment goes toward principal. Not a lot at first, but something. He sees home prices in the neighborhood creeping up. A similar house down the street sells for $325,000, and Alex feels like he just made $25,000 without doing anything. His family tells him he made the right decision. His friends ask him about the house. His co-workers talk about interest rates and property values. Owning a home feels serious. It feels responsible. It feels like progress. Noah doesn't get any of that. He transfers $600 into his brokerage account every month. Sometimes the market is up, sometimes it's down. Sometimes he logs in and sees he made $4,000 in a month, and sometimes he sees he lost $7,000 in a week. Nobody congratulates him for continuing to rent. Nobody says, "Wow, you're really building wealth with that index fund." He just keeps investing quietly. By year 3, Alex has paid about $57,600 in mortgage payments. But because early mortgage payments are mostly interest, only around $15,000 to $18,000 of that actually reduced his loan balance. The rest went to the bank. He also paid about $12,600 in property taxes, around $4,300 in insurance, and probably $7,000 to $10,000 in maintenance and repairs. Maybe nothing dramatic happened. Maybe it was just a dishwasher, a fence repair, a plumbing issue, a few trips to Home Depot, and one weekend where he spent 8 hours doing something he thought would take 45 minutes. But it counts. After 3 years, Alex's house might be worth around $328,000 if it appreciated about 3% a year. His mortgage balance might be around $224,000. That means his equity is roughly $104,000. That sounds amazing until you remember he started with $60,000 and spent thousands more on taxes, insurance, repairs, and closing costs. Still, Alex is building wealth. No question. Noah, meanwhile, put his $60,000 into the market and invested $600 a month for 3 years. Assuming roughly 10% average annual returns, his portfolio is somewhere around $110,000 to $120,000. He didn't replace anything. He didn't call a contractor. He didn't spend Saturday learning what a shut-off valve is. He just invested and moved on with his life. At year 3, they're surprisingly close. Alex has more emotional satisfaction. Noah has more flexibility. Alex has equity trapped inside a house. Noah has money he can access with a few clicks, but this is where most people make the first major mistake. They compare Alex's mortgage payment to Noah's rent and stop there. They say, "Why would I pay $1,700 in rent when I could pay $1,600 for a mortgage?" Because the mortgage is not the cost of owning a home. It's just the cover charge. The real cost includes property taxes, insurance, maintenance, repairs, closing costs, transaction fees, interest, furniture, appliances, landscape, tools, HOA fees if you're unlucky, and the big one nobody likes to talk about, the opportunity cost of the down payment. That $60,000 Alex put into the house didn't disappear, it became equity. But it also stopped being invested elsewhere. If that $60,000 had been invested in the stock market for 20 years at 10% average annual return, it could become more than $400,000 by itself. That's the invisible cost of buying. You don't feel it because nobody sends you a bill called opportunity cost, but the math is still happening in the background. By year 5, Alex is deeper into homeownership reality. His house is worth maybe $348,000. His mortgage balance is around $212,000. His equity is now roughly $136,000. That looks great, but over those 5 years he's paid around $96,000 in mortgage payments, maybe $21,000 in property taxes, $7,000 in insurance, and somewhere around $15,000 in maintenance, repairs, and improvements. And improvements are the sneakiest category of all, because homeowners love to pretend upgrades are investments. New flooring, better countertops, a nicer bathroom, a deck, new paint, better lighting, landscaping. Some of it may increase value, but almost never dollar for dollar. You spend $20,000 making the house nicer, and maybe the house is worth $8,000 more, maybe $12,000, maybe nothing, because buyers already expected the house to be maintained. But emotionally you don't count it as a cost. You count it as making your house better. Noah is still renting. His rent has gone up from $1,700 to maybe $1,850. That's real. Rent inflation hurts. But Alex's costs have gone up too. Property taxes rose, insurance rose, maintenance didn't get cheaper, the house got older. Noah's portfolio after 5 years, with the original $60,000 and $600 monthly investments, is sitting around $160,000 to $180,000 depending on the market. He has no house, but he also has no roof to replace. And here's what's happening under the surface. Alex's wealth is growing in a straight line mixed with appreciation. Noah's wealth is growing in a curve, slow at first, then faster. The early years of investing feel unimpressive because most of the money is still your contributions. Later, the portfolio starts producing more growth than you personally put in. Compounding is boring at $60,000. It becomes interesting at $200,000. It becomes ridiculous at $500,000. By year 10, Alex's home is worth roughly $400,000 if it appreciated around 3% a year. His mortgage balance is around $178,000. That gives him about $222,000 in home equity. That is real wealth. But it's not the same as having $222,000 in cash. To access it, he has to sell the house, refinance, or borrow against it. And if he sells, he has transaction costs, realtor commissions, closing fees, moving costs, repairs before listing. Selling a house can easily cost 6 to 8% of the sale price. On a $400,000 house, that could be $24,000 to $32,000 gone immediately. Noah's portfolio, after 10 years, with $60,000 up front and $600 a month, at roughly 10% annual returns, is around $300,000 to $330,000. He put in $60,000 up front, plus $72,000 over time. $132,000 total. The rest is market growth. At year 10, Noah might actually be ahead financially, even though Alex has the house. But Alex has something Noah doesn't. Stability. His payment is mostly fixed. Yes, taxes and insurance can rise, but the mortgage itself doesn't reset every year. Noah's rent can go up. His landlord can sell. He can be forced to move. He might need a bigger place, a better school district, or more space for a family. This is where the spreadsheet starts to break. Because buying a home is not just an investment. It's also a lifestyle decision, disguised as a financial decision. If Alex loves the house, stays for 20 years, raises a family there, locks in his housing cost, and avoids lifestyle inflation, the house might be one of the best decisions he ever makes. If he buys too much house, stretches his budget, constantly upgrades, refinances to pull cash out, and treats home equity like a credit card, the house can quietly keep him broke for decades. The asset isn't the problem. The behavior around the asset is the problem. By year 20, Alex's home is worth roughly $540,000. His mortgage balance is around $75,000, assuming he stayed on the original 30-year schedule. His equity is about $465,000. That sounds like a victory. And in many ways it is. He started with $60,000 and now controls an asset worth more than $500,000. He has a place to live. His housing payment didn't explode like rent might have. And in 10 more years, the mortgage could be gone completely. But the full math still matters. Over 20 years, Alex paid about $384,000 in mortgage payments. He paid maybe $100,000 in property taxes, $35,000 in insurance, and easily $80,000 to $120,000 in maintenance, repairs, replacements, and upgrades. Some of those costs were necessary. Some were lifestyle. Some were emotional. All of them were real. Noah, after 20 years of renting and investing the difference, has a portfolio somewhere around $750,000 to $850,000 if he kept investing $600 a month and earned roughly 10% average annual returns. That's the part that makes people uncomfortable, because Alex looks richer from the outside. He has the house, he has the driveway, he has the neighborhood, he has the story. Noah has a rented apartment and a number on a screen, but the number on the screen may be bigger. And unlike home equity, that money is liquid. He can rebalance it, withdraw from it, move cities, buy a house later, retire earlier. Use it for opportunities. He has optionality. Alex has stability. Noah has flexibility. And which one is better depends less on the investment and more on the person. But now, let's be fair in the other direction, because renting and investing only works if you actually invest the difference. That's the entire strategy. If Noah rents for $1,700, sees that Alex spends $2,300 owning, and then spends the $600 difference on food delivery, vacations, car payments, and random upgrades to his life, he doesn't win. He just rents. This is why the phrase rent and invest the difference is so dangerous. Most people rent and spend the difference. Buying a home creates forced savings. Every month, whether Alex feels motivated or not, part of his payment reduces the loan balance. The house forces him to build equity. Noah has to voluntarily build wealth every month for 20 years. During bull markets, crashes, layoffs, boredom, recessions, and moments where everyone around him is saying, "You still rent?" That takes discipline. And discipline is not a small detail. It's the whole game. Stocks also come with a psychological cost people underestimate. In 2008, the market dropped hard. In 2020, it crashed brutally fast. There will always be moments where Noah logs in and sees years of gains disappear in weeks. A $500,000 portfolio can become $350,000 before breakfast, at least on paper. And if he sells during the panic, the math is dead. The stock market rewards patience, but it tests patience by making you feel stupid at exactly the wrong time. A house doesn't show you a daily price. That's one of its biggest hidden advantages. Alex doesn't wake up and see his house down 22% on an app. He doesn't panic sell because Zillow had a bad morning. Real estate feels stable, partly because it's illiquid and slow-moving. You can't emotionally trade your house every Tuesday. That lack of liquidity can be a weakness, but it can also protect people from themselves. So when does buying win? Buying wins when you stay put for a long time. The longer you hold, the more closing costs and transaction fees get spread out. Buying a house for 3 years can be expensive. Buying for 20 years can be powerful. Buying wins when the monthly cost is reasonable compared to rent. If owning costs only slightly more than renting, and you can comfortably afford the down payment, the math gets much better. Buying wins when you don't over-upgrade. The person who buys a modest house and maintains it builds wealth. The person who buys a house and turns every weekend into a renovation project may just be converting income into countertops. Buying wins when it improves your quality of life in ways renting can't. Space, stability, schools, pets, family, control. These are not spreadsheet items, but they matter. And buying wins when it creates forced savings for someone who otherwise wouldn't invest consistently. But renting wins too, in specific situations. Renting wins when home prices are too high relative to rent. If renting costs $2,000 but owning the same lifestyle costs $4,000, the gap is enormous. Invest that difference consistently, and the stock market has a serious advantage. Renting wins when you might move. Buying and selling within a few years can destroy returns through transaction costs alone. Renting wins when you value flexibility. New job, new city, new relationship, new business, new life. A lease is easier to escape than a mortgage. And renting wins when you have the discipline to invest the difference instead of quietly spending it. That's the real math. Not buying is always better. Not renting is throwing money away. Renting is not throwing money away. It's buying shelter and flexibility for a period of time. And owning is not automatically investing. Sometimes it's building wealth. Sometimes it's buying a very expensive lifestyle with debt attached to it. Alex and Noah both thought they were making the obvious smart choice. Alex thought owning a home was the foundation of wealth. Noah thought renting and investing would beat the system. Neither of them was automatically right. The winner depends on the numbers, the city, the rent, the mortgage rate, the maintenance costs, the time horizon, the market returns, and the behavior of the person making the decision. Because the real trap isn't buying, and it isn't renting. The real trap is comparing a mortgage payment to rent and pretending that's the full calculation. It's not. The full calculation includes every cost, every repair, every tax bill, every rent increase, every investment contribution, every missed opportunity, every emotional decision, every year you stay, every year you don't. And if you're wondering what happens when someone buys a modest house, keeps their housing costs low, and still invests aggressively at the same time, that's a completely different conversation, because that might be the real wealth-building cheat code. But for now, the next time someone tells you renting is throwing money away, ask them one question: did you include everything? Because the answer that includes everything is the only answer that matters.